Ethereum will flip the network value of Bitcoin. Bitcoin may be headed to $1 million. That's the headline everyone already knows. But here's the shocker. Tom Lee believes Ethereum could go even bigger. Why? Because Bitcoin and Ethereum are not the same thing. Bitcoin is the ultimate store of value, the digital version of gold, scarce and untouchable. But Ethereum is becoming something entirely different, the infrastructure of value. It's the operating system for money, the rails for Wall Street, the foundation for stablecoins, and even the backbone for the coming wave of AI. Think about that for a second. Bitcoin is an asset. Ethereum is a platform. Bitcoin is a vault. Ethereum is a city. A financial internet where trillions of dollars in assets, contracts, and machine-to-machine transactions could one day flow. And that's why Tom Lee argues this isn't about one coin replacing another. It's about two different markets colliding, digital gold on one side and the tokenization of the entire real world on the other. If he's right, Ethereum won't just catch up to Bitcoin's valuation, it could surpass it entirely. In this video, we're going to break down Tom's bold thesis with his own words. We'll play the key clips, then I'll translate them into plain English and unpack what they mean for investors like us. But before we dive in, a quick reminder. Only a small percentage of you watching right now are subscribed. If you're finding value in these deep dives, hit that subscribe button. It's free. It helps the channel grow. And you can always change your mind later. First, let's start with Bitcoin, because Tom's not bearish on it. In fact, his call is still massive, $1 million per coin, as institutions and governments scramble to grab what little supply is left. It's easy to forget just how powerful Bitcoin's story already is. Over any 10-year period in its history, Bitcoin has been the best performing asset in the world. From pennies to tens of thousands of dollars, it's been the single greatest example of what happens when technology collides with scarcity. And today, at around $110,000, Tom says Bitcoin has matured. Institutions now see it not as a gimmick, but as a legitimate way to store value. Hedge funds, pension funds, even governments are circling around it as a reserve asset. Here's Tom explaining the bull case in his own words.
Well, Bitcoin has done very well over any 10-year period. And at $100,000 today, it does reflect that institutions are beginning to view this as a legitimate way to store value. Because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. That's a stat from Bitwise. But that 5% that isn't held yet, because the other Bitcoin is basically being hodled, has to be acquired by those 95% of institutions. Plus now governments want to own Bitcoin as a strategic reserve. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million per Bitcoin.
This is the foundation. Bitcoin as digital gold, fixed supply, deep conviction holders, and an adoption curve that still has 95% of institutions on the sidelines. If even a fraction of them decide they need exposure, if sovereign wealth funds or central banks decide they need Bitcoin on their balance sheets, the math pushes Bitcoin toward Tom's $1 million target. It's the same logic that gold rode for decades. Gold's network value today sits around $22 trillion. For Bitcoin to simply match gold, not replace it, not surpass it, that would already imply more than a 10 times from current levels. That's the power of scarcity combined with demand. But here's the thing. For Tom, the real story isn't just Bitcoin. Bitcoin is the vault, the reserve asset. The bigger prize is what's being built on top of crypto, the rails, the infrastructure, the programmable layer, and that's where Ethereum enters. For Tom, Ethereum is at its 1971 moment. To understand what he means, we need to rewind. In 1971, President Nixon took the US dollar off the gold standard. It was a seismic shift. Suddenly, the dollar was no longer backed by gold. It became what Tom calls a synthetic asset. At the time, people flocked to gold as a hedge, but what mattered more was what happened next. This change unlocked modern Wall Street. With the dollar no longer tied down, an entire universe of financial innovation became possible. Derivatives, futures, bond markets, interest rate products. Without that shift, Wall Street might still be a niche business today. Tom believes Ethereum is now standing at that same kind of turning point. Only this time, the rails aren't being laid on dollars, but on blockchains. And the chain Wall Street is choosing isn't Bitcoin, it's Ethereum. Here's Tom laying it out.
And then we have Project Crypto, which is the SEC wanting Wall Street to build on the blockchain. Now, all that collectively, from a Wall Street perspective, is like 1971 for the dollar. And what I mean by that is, in 1971, the dollar went off the gold standard. So in 1971, the dollar became synthetic. And gold was what people bought as a hedge against that synthetic dollar. So you had gold as the trade, and that would be the Bitcoin equivalent. But actually, the synthetic dollar is what created the rails for Wall Street to build all their future products. The futures, curves, derivatives were all because the dollar was a synthetic product. If the dollar was backed by gold, Wall Street would be still a very small business. Well, Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity.
That's the crux of his thesis. Bitcoin is the hedge. Ethereum is the infrastructure. Bitcoin is the vault where value sits. Ethereum is the city being built on chain, the marketplace, the highways, the buildings, the digital rails for everything else. And just like the dollar's decoupling from gold unleashed decades of exponential growth in financial products, Ethereum could unleash the same in the digital age. Tokenized assets, programmable contracts, on-chain settlement for trillions of dollars in value. This is why Tom calls it a 1971 moment. Because when you zoom out, Ethereum isn't just another cryptocurrency. It's the foundation Wall Street itself is starting to build on. And if that's true, it changes the scale of what Ethereum could become. So what's driving this shift toward Ethereum? One word: stablecoins. For years, people debated what the first killer app of blockchain would be. Would it be DEFI, NFTs, gaming? But the answer snuck up on everyone: stablecoins. Dollar-pegged tokens that move at internet speed without the friction of banks. Stablecoins have exploded into a $250 billion market. And here's the key: the vast majority live on Ethereum. Every time someone mints, transfers, or redeems one, it drives activity and burns ETH. And now comes the catalyst that changes everything: the Genius Act. For the first time, US banks are being greenlit to build and issue stablecoin products directly on-chain. What was once a crypto-native tool is becoming a Wall Street-grade instrument. Here's Tom explaining why that matters.
The stablecoins became really a breakaway product for crypto. And that's like the ChatGPT moment. There's $250 billion worth of stablecoins. The vast majority of those are minted on Ethereum. Then the Genius Act was passed by this administration and this Congress, and that greenlighted the proliferation of stablecoins onto the blockchain. So banks are now building stablecoin products. That Treasury Secretary Bessent thinks that could get to $4 trillion. That's exponential growth, burning gas on Ethereum.
This is the kind of persistent, institutional-grade demand that changes a network forever. Unlike meme coins or hype cycles, this isn't speculative froth. This is structural adoption. Millions of people already use stablecoins every day to move money across borders, to settle trades instantly, to escape inflation in emerging markets. And now, when banks step in, that usage could scale from billions to trillions. Tom highlights Treasury Secretary estimates that the stablecoin market could balloon to $4 trillion. At that level, stablecoins would rank among the largest holders of US treasuries in the world. In other words, stablecoins stop being a crypto sideshow and start becoming a cornerstone of the global financial system. And every single one of those transactions, every mint, every transfer, every redemption, they're powered by Ethereum's block space. They burn ETH. They reinforce its role as the monetary layer of the internet. That's why Tom compares stablecoins to crypto's CHATGPT moment. It's the product that took something abstract and made it obvious, viral, unstoppable. And the more stablecoins grow, the more Ethereum becomes indispensable. The second megatrend Tom highlights is artificial intelligence. So far, AI has mostly lived in chat windows. CHATGPT, Midjourney, assistants that generate text or images. But the next evolution is far bigger: autonomous AI agents. Imagine thousands, then millions, then billions of AI systems that don't just talk, but act. They'll buy services, sell data, execute code, order goods, and even control machines in the physical world. And when that happens, trust and verification become critical. How do you know the instructions sent to your self-driving car actually came from you and not a malicious actor? How does one AI pay another for access to compute or data? How do machines transact across borders, across companies, across chains? This is where Tom believes Ethereum steps in. Here's his explanation.
Because now we're moving towards an agentic AI world, but with real products. Like AI is principally been trained on like internet and social media, but it hasn't been in the real world because it hasn't ingested us as we've moved and physically moved or even had independent products. That's a vast amount of new information for AI models to ingest and store. But then now you have to be sure that all the instructions being sent back to the robot are proof of the originator. In other words, you need a token. I mean, LLMs use tokens anyways, but now you need like a token that interacts across chains. And that's where AI is going to build on Ethereum, because you essentially need what they call proof of human. Mm-hmm. We need to prove that this lawnmower got a real instruction from another chain or another vendor. And so that is all being built on Ethereum.
Think about it. In the future, billions of AI agents could be making constant microtransactions, paying for cloud compute by the second, unlocking access to a data set for a fraction of a cent, tipping another agent for completing a task, or verifying that a robot instruction came from its true owner. That world needs three things. Number one, identity, proof that the actor is real and authorized. Number two, payments, fast, cheap, global settlement. And number three, interoperability, the ability for agents across networks to trust each other. Ethereum is uniquely positioned to provide all three. With its smart contracts, established liquidity, and ecosystem of layer 2s, it already acts as a programmable settlement layer. Add in the ability to issue tokens for identity and verification, and you have the backbone for a machine-to-machine economy. Tom calls this proof of human, a way to guarantee that instructions and transactions originate from legitimate sources. And as AI pushes further into the real world, that verification layer won't be optional. It will be essential. That means every AI interaction, every payment, every instruction, every tokenized confirmation has the potential to run through Ethereum. And if that future plays out, the demand for Ethereum's block space will grow not just linearly, but exponentially. This is where Tom goes bold. He doesn't just say Ethereum will grow, he says it can flip Bitcoin in total value. For years, the flipping has been a meme in crypto circles. Most dismissed it as impossible. Bitcoin had the first mover advantage, the supply cap, the brand, the mindshare. But Tom isn't approaching this from tribalism. He's approaching it from scale. Bitcoin monetizes gold. Ethereum, he argues, monetizes everything else. Here's how he explains it.
But before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and Project Crypto, I think Ethereum's essentially the value of its protocol layer, like Union Square Ventures calls it the fat protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. Like, so if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin.
That's the flipping case. Bitcoin monetizes gold. Ethereum monetizes the entire financial system. Think about the math. Gold is a $21 trillion market. If Bitcoin captures that, Its upside is enormous, but it also caps out there. Ethereum, on the other hand, sits at the heart of tokenization. Stablecoins, bonds, equities, real-world assets, AI-driven microtransactions, all of them require settlement rails. All of them require programmable logic. All of them generate demand for Ethereum. And if even a fraction of the world's financial assets migrate on-chain, we're not talking trillions, we're talking hundreds of trillions in value. That's an addressable market far larger than gold, and far larger than what Bitcoin alone can capture. This is why Tom calls Ethereum the fat protocol. The value accrues not just to the tokens or the apps built on top, but to the base layer itself. Every transaction, every contract, every tokenized asset eventually settles back to Ethereum. Bitcoin is the vault, Ethereum is the financial system. One protects wealth, the other creates and moves it. If Tom is right, the flippening isn't a matter of if, but when. So here's the takeaway. Bitcoin equals digital gold. It's on a path to $1 million and beyond as institutions, governments, and sovereign wealth funds scramble to secure the last scarce asset on Earth. Ethereum equals tokenized everything. It's not just a coin, it's infrastructure. It's the base layer for Wall Street, stablecoins, real-world assets, and even AI. Its potential market isn't $20 trillion, it's hundreds of trillions. The 1971 moment is happening right now. Just like the dollar's break from gold unleashed decades of growth in finance, Ethereum is unleashing the financial internet, and the rails are being laid today. If Tom Lee is right, the flippening won't be a meme, it won't be a fantasy, it'll be an inevitability. Bitcoin as the vault, Ethereum as the system. One preserves wealth, the other runs the world. And if you want to stay ahead of these signals, who's buying, where flows are going, and when the market is flashing heat, I break it down every day in the Crypto Nutshell. It's my free 5-minute crypto newsletter built for investors who want quick, actionable insights without the noise. First link in the description, drop your email, and you're in. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you in the next one.